It is no question that AI is the modern day gold rush. But if you remember from school, during the gold rush, most people did not find what they were searching for and ended up broken. How do we make sure that the same thing doesn't happen to us as investors amid the rise of AI? The answer is quite simple actually. We invest in the tools. What you have to understand is that during the gold rush, ones who made the most profit were the ones selling the tools, shovels and pickaxes. And that is exactly what we want to invest in, into the technology behind all AI, companies that engage in semiconductor processing equipment manufacturing. There are currently four such big players in the world: ASML, Lam Research, Applied Materials, and Tokyo Electron. Today, we will focus on three of these companies: Lam, Applied Materials, and ASML. First, jumping to Lam Research, this company is currently down by 8.13% over the past year, but over the past 5 years, they are up by 190%. What I love is the fact that they have a very diverse geographical portfolio with 14 primary locations, from which 6 are in the US and 6 in Asia. This might frighten some, as it would mean that the company is in quite a lot of danger from tariffs, but that wouldn't exactly be the case, as more than 3/4 of their revenue comes from Asia, meaning that it is not subjected to tariffs because it comes from the Asian manufacturing sites. Nevertheless, moving to the 9-pillar analysis, as you can see for Lam Research, everything is sitting in the green. When we jump to pillar 1 though, there is one thing I don't like, and that is the fact that the company has been getting more and more expensive through the past 5 years, with their PE rising from 10.70 in 2020 to 29.72 in 2024. Currently it is sitting at 23.61, which is better, but it is still quite higher than the 5-year average. So the company is quite expensive compared to what they have been trading in the past. And that is actually the same case with the price to free cash flow, which has been rising quite a lot through the past 5 years. Nevertheless, the company's revenue though has been rising as well, rising from 10 billion in 2020 to almost 15 billion in 2024, rising at a CAGR of about 10%. That is the similar case with the net income, which has been growing at a CAGR of almost 15% through the past 5 years, and free cash flow, which has been growing at a CAGR of about 8.5%, growing from 3.2 billion in 2020 to 3.8 billion in 2024. So as you can see, Lam Research has been showing us some great growth through the past few years. Now, another thing I like about the company is the fact that they have been returning a lot of value to investors through share buybacks. As you can see, through the past 5 years, they bought back about 11.5% of all their shares outstanding, which means that essentially their value rose by 11.5%. They have also been returning a lot of value through dividends, with their 5-year dividend CAGR sitting at almost 15%, and this dividend CAGR actually being quite safe, with the 5-year free cash flow payout ratio sitting at only about 24%. And if I scroll down, you can see that it actually has been quite stable through the past 5 years, hinting that a CAGR of this size is probably quite sustainable. Now, looking to the last pillar, pillar 9, you can see the long-term liabilities of the company. Lam has been lowering their long-term liabilities at quite a high rate through the past 5 years, with their long-term liabilities over the 5-year free cash flow negative dividends ratio sitting at only 0.3, meaning that the company would be able to pay off all of them in about 1.5 years, which is great. So overall, the 9 pillars are looking very decent for this company. It is looking like their business is growing and that they have a bright future ahead. But now let's calculate their intrinsic value and figure out if they are in our buying range. Moving to the Grams formula, I will predict the future EPS growth at 13.67% yearly, and this will give us an intrinsic value of $77.68, a little lower than the current trading price. For the second valuation model, the discounted cash flow model, we will plug in the free cash flow through the past 5 years, and based on that, predict a growth rate into the future of 8.7%, which will give us an intrinsic value of $72.93 with a discount rate of 9%. If you don't know what the discount rate is, it is essentially my minimum wanted rate of return. Moving to the third valuation model, the multiples valuation, we will compare Lam Research to 2 of its competitors. The other 2 companies we will have a look at in this video, and as you can see, the intrinsic value comes out at $88.40 when we compare these companies' P ratios to the PE ratio of Lam Research. Now, moving to the final valuation model, the dividend discount model, I will project the dividend CAGR a little lower than the 5-year dividend CAGR of almost 15%, as I don't believe that the free cash flow of the company will grow at this rate, meaning that the company won't be able to keep their dividend CAGR at this high of a percentage. And as you can see, with a projected dividend CAGR of 8%, the intrinsic value still comes out really high at $99. Finally, moving to the ultimate valuation, we will average out all 4 values we just calculated and get an ultimate intrinsic value of $84.59, which is spot on with the current trading price. But with a margin of safety of 10%, our acceptable buy price would be at $76.13, meaning that the company would currently be a hold, but very soon might become a buy if their stock price slides a little. The second company we will have a look at is ASML, arguably the biggest monopoly in the semiconductor manufacturing business. This company is well known as the GOAT for providing the most modern and high-end EUV, extreme ultraviolet lithography equipment, which is used to create the most powerful AI ever. And over the past year, they are down by almost 22%, recently hitting their 52-week low of $578. So let's jump to our 9 pillars and figure out if at their current trading price, they are in our buying range. But before we get to that, I just want to mention that me and my team have been working on a free website as well as a free course where investors such as yourself will be able to analyze any company using the 9 pillars and later value them through many intrinsic valuation models. So if that sounds interesting, make sure to hit that subscribe button to not miss out. And now back to the valuation. Looking at the 9 pillars, you can see that 2 are sitting in the red, and both of these pillars are actually the pricing of the company. When we look at pillar 1, you can see that the PE ratio has risen a lot through the past 5 years, sitting at an average of 33.18. Though in my opinion, this is quite acceptable as the company is a real monopoly in the semiconductor business. And actually currently their PE ratio is quite lower than the 5-year average, meaning that the company might be at a discount compared to what they have been trading in the past. Now, looking at pillar 3, you can see that the company's revenue has increased from 14 billion in 2020 to almost 30 billion in 2024, growing at an extremely high CAGR of 17.5%. The net income has also been growing extremely well at a CAGR of 22.41%, and their free cash flow has increased from $3.6 billion in 2020 to $9 billion in 2024, an increase of almost 150%. Now, another thing I like about ASML is that they have a very steady profit margin with a slightly increasing return on investing capital, which is great. They've also been buying back shares through the past 5 years, decreasing the overall shares outstanding by about 6%, and they are paying out the dividend, which has been increasing through the past 5 years at a CAGR of about 5%. Now, finally, moving to pillar 9, you can see that the company's long-term liabilities over the 5-year free cash flow negative dividends ratio is sitting at only 0.14, meaning that they wouldn't have an issue at all paying off all their long-term liabilities of about 4.5 billion with their yearly free cash flow. Now, moving to the Graham's formula, let's try to calculate the company's intrinsic value. I will predict an earnings per share growth of 22.67% into the future and get an intrinsic value of $738.73, essentially spot on with the current trading price. For the discounted cash flow model, I will predict the future long-term free cash flow CAGR at 13.7%, and with a discount rate of 9%, we will get an intrinsic value of $759.13, slightly higher than the current trading price. Now, moving to the multiples valuation, we will compare ASML to the 2 competitors, Applied Materials and Lam Research, and get an intrinsic value of only $545.17, as it is quite more expensive than its 2 competitors. Now, as ASML is the only company in the world that does extreme ultraviolet lithography, I do believe that they deserve a very big premium, and that's why we will actually not use the multiples valuation in ASML's case. We will neither use the dividend discount model, as ASML's dividend raises have been quite off and only recently have they started paying out their dividend quarterly. So arriving to the ultimate valuation, we will average out the grounds formula and the discounted cash flow model and get an ultimate intrinsic value of $748.93, which is essentially spot on with the current trading price. And with a margin of safety of 10%, our acceptable buy price would be at $674, which would mean that the companies currently hold, but taking into account that they are a huge monopoly, I would probably say that buying them at this current trading price would bring you great returns into the future. Finally, let's have a look at Applied Materials, which is currently the biggest semiconductor processing equipment manufacturer in the world by revenue, although it will probably soon be overtaken by ASML. The company doesn't really focus on any segment of semiconductor processing equipment manufacturing like ASML or Lam, which focuses on etching and deposition. They are actually kind of an all-in-one deal, not having the biggest market share in any segment, but rather being present in all segments. And over the past year, they are down by 24%, again recently reaching their 52-week low of $123.74. So again, jumping to the 9 pillars, you can see that the rating is 9 out of 9 with all the pillars in the green. Looking at pillar 1, you can see that although the PE has been growing, it is currently sitting at only 19.72, which is lower than the average stock PE ratio. That is the same case with the price to free cash flow, which is sitting at 22.72, higher than the 5-year average, but very close to the average stock price to free cash flow. Looking at their revenue, you can see that it has grown from 17 billion to 27 billion in 2024, growing at a CAGR of almost 11%. Their net income has been doing even a better job, growing at a CAGR of 15.5%, with their free cash flow growing at an extremely high CAGR of 25.25%. Something I also like about the company is that they have been buying back a lot of shares. They have bought back about 9.5% of all their shares outstanding, returning a lot of value to investors. And similarly to Lam Research, they also have a very high 5-year dividend CAGR of 15%, with their dividends rising steadily through the past 5 years and their free cash flow payout ratio actually decreasing from 23% in 2020 to 16% in 2024, hinting that this high dividend CAGR is here and will probably continue into the future. And finally, looking at their debt, as expected, the company doesn't have much debt at all, with their long-term liabilities actually decreasing and their ratio sitting at only 0.22. Now, moving to the grounds formula, we will plug in the earnings per share growth estimate at 14%, a little lower than for ASML, but a little higher than for Lam Research, and get an intrinsic value of $188.75, 16% higher than the current trading price. For the discounted cash flow model, I will plug in the 10-year free cash flow CAGR at 9%, and with a discount rate of 9%, we will get an intrinsic value of $218.32, again higher than the current trading price. For the multiples valuation, we'll compare Applied Materials again to Lam Research and ASML and get an intrinsic value of $218. And for the dividend discount model, I will project a dividend CAGR of 9% to be conservative. And with the alternative model, we will get an intrinsic value of $222.82. So moving to the ultimate valuation, we will average out the 4 values we just got and get an ultimate intrinsic value of $212, which is 31% higher than the current trading price. And so with a margin of safety of 10%, our acceptable buy price would be at $190, which is higher than the current trading price, which means that Applied Materials is well in our buying range, and I would rate it as a strong buy. Overall, I would say that all these companies are somewhat in their buying ranges, with Applied Materials and ASML being the ones I would personally choose to buy into at their current trading prices. Applied Materials seems to currently be the most undervalued, with ASML having the highest future potential of all 3 companies thanks to its monopoly. I hope that you enjoyed the video, and make sure to subscribe to not miss out on the new free valuation website me and my team are bringing live in just a month's time.